Hi, everybody. This is Ellman, the Blue Collar Investor, and welcome to this BCI webinar titled How to Set Up a Covered Call Writing Portfolio Using Stock Selection, Option Selection, and Position Management. We're going to walk everybody through the process, start to finish. And this is going to be a step-by-step analysis using our newest educational product, the Elite Plus Calculator. So I'll show you from the ground floor how to set up our portfolios using this new tool. I'm here tonight with Barry Bergman, BCI Managing Director, who is available to answer your questions in the chat box in this Zoom presentation. So please take advantage. Barry is amazing at answering questions. We did 2 webinars earlier this week where there were about 1,500 attendees, and Barry was just typing responses start to finish. So please take advantage of that. And I'm also here with Darius in the background. He's recording this presentation. If you want to watch it again later on, we'll send everybody a link. And he's also the one allowing everybody to get into this webinar. And I see we have quite a crowd here tonight. So thank you all very, very much for attending. I'm going to work very hard to make this a worthwhile hour for you. So let me give you an overview now as to what we're going to be working on over the next hour. I always start my presentations with a few slides on option basics. And the reason is that we're so fortunate that we're constantly getting new members into the BCI community. And many of them, like myself and Barry, we started out knowing nothing about options. So I like to establish a foundation with just a couple of slides on the basics of options, and then we'll move right into what is covered call writing. And then I'll talk about something that you hear me talking about all the time, the 3 required skills as they apply to establishing our portfolios each month or each week. Now, we're going to show you how the Elite Plus Calculator will give us not only individual positions in our portfolio, but overall portfolio calculations and returns. So we're really highlighting this new tool, but basically all of the guidelines and principles that so many of you are used to using over the last 12 or 13 years is inherent in this particular spreadsheet. At the very end, I'm going to spend about 2 minutes going over some of the educational products available in the Blue Collar store. Most of you probably have most of them or are aware of them, but we're going to review that very briefly in maybe over 2 minutes. I am going to be giving out 2 discount promo coupons. That's good for tonight and tomorrow. And also we're going to discuss the free resources on the bluecollarinvestor.com website. As many of you know, we have a huge resource that we offer for free on our website. At the very end, I'll summarize, and if there are any questions left at the end, I'll check back in with Barry, and I'll be happy to respond to them. Okay. Let's launch this webinar with some basic definitions. An option. What is an option? Well, I call it a made-up thing. It's a contract that gives the buyer of that option the right but not the obligation to either buy or sell 100 shares of stock at a fixed price, called the strike price, by a specified date known as the expiration date. Now, monthly contracts, which is what I use, expire on the 3rd Friday of the month, 4 p.m. Eastern Time. And the reason for 100 shares is because for every 1 options contract that we buy or sell, it's the equivalent of 100 shares of the underlying security. So a contract, an option is the right to execute a future stock transaction. Now, a call option, which is what we're focused in on this evening, gives the holder or buyer the right but not the obligation to buy 100 shares of stock at the strike price by the expiration date. So when we do a covered call, we are selling some unknown person the right but not the obligation to buy our shares from us at a price that we determine, the strike price, by a date that we determine, the expiration date. So call options can also be used in conjunction with put options in what is known as the PCP strategy, or put strategy, in our books and DVD programs. Some people reference this as the wheel strategy. But we're going to focus in on calls tonight. Put option is the opposite of a call option. It gives the buyer of that option the right to sell 100 shares of stock at the strike price by the expiration date. Now, a very, very important concept regarding options is the moneyness of the option. And this is the most challenging slide to those beginning their option selling careers. So those that are just starting out, and we've had a huge number of new members over the last couple of months. I want to tell you that if you don't get this right away, this slide, I'm going to be repeating it and showing it over and over again over the course of the next hour or so. So an at-the-money strike is when the price of the stock is the same as the strike price of the option. So if we bought a stock or perhaps already owned it at $30, and then we sell the $30 strike or the right to buy our shares from us at that $30 price, that strike price is known as at the money. Now, very closely related to that is the near the money strike. Now, a near the money strike is when the price of the stock and the strike price of the option are almost the same, but not precisely the same. So an example would be a stock trading at $29.95, and we agree to sell it for $30. So that's, most option traders will reference that as a near the money strike. Now, the most popular, by far and away, of all the covered call strike prices is the out of the money strike. And that's where we're agreeing to sell our shares for a price higher than the current market value. An example would be a stock trading at 28, and we sell the $30 call option. The reason it's so popular is that it allows us the possibility or the opportunity to generate two income streams in the same month. One from the option premium, and the other from the sale of the stock from the current market value, in this case 28, up to the $30 strike price. Now, the fourth bullet is the in the money strike, and that's the one that most covered call writers never use, except within our BCI community, because I've been stressing it now for the last 13 years. An example of an in the money strike is a stock trading at 32, and we agree to sell it at 30. So the way that trade is structured, we're automatically losing $2 on the sale of the stock. So why the heck would we do that? The answer is the option premium that we receive when we sell an in-the-money strike will compensate us for the $2 we're going to lose on the sale of the stock, plus a little bit more. And it's that little bit more that represents our actual initial time value return. So we're going to break this down now in this slide right over here. So we're going to give you the premium consists of intrinsic value plus time value. Now here's the thing. Intrinsic value applies only to in-the-money strikes. So if we sell an at-the-money strike, buy a stock at 30 and sell the 30 call, or an out-of-the-money strike, buy a stock at 28 and sell the 30 call, those are not in the money. They're at the money, out of the money. Therefore, the premiums we generate are all time value. So if we sold an in-the-money strike, the example I gave before, a stock trading at 32, we sell the $30 in the money, lower than current market value, strike price. If we generated a premium of $3, would it be fair of us to say that we've generated $3 of profit? No, because we're losing $2 on the sale of the stock. That is the intrinsic value component of the premium. So we must deduct that $2 from the $3, and that will give us our real actual time value profit, in this case, $1. Now, I know that just about everybody listening to this webinar has a copy of the Ellman calculator, either the basic, the elite, or maybe even the elite plus. You know that those calculators will deduct the intrinsic value component from the total premium and will let us know what our real initial time value profit is. So those of you who don't have a copy of the basic calculator, at the end of the presentation, I'll tell you how you can get a free copy of it. But most importantly, I don't want you to worry for a second about doing this math. The calculators will do all that for us. Okay, let's move on to covered call writing, and we're going to define it by defining the 3 words in the term covered call writing. Covered means we are protected. We buy the stock first before we sell the option. We're not doing a naked option trade, which is very risky. So we buy the stock, we know our cost basis, we're agreeing to sell our shares for a certain price, and that's based on the price of the stock at the time we made the trade. Not if we purchased this stock 3 years ago and it was 1/3 the price. We don't base it on that. We base it on what the price is at the time we execute the covered call trade. So covered means protected, means we know our cost basis. Now the second word in the term is call, and that relates to the type of option we are selling. So once again, we are selling some unknown person the right, but not the obligation, to buy our shares from us at the strike price by the expiration date. We have obligations as option sellers, and the option buyers have rights, and they have the right to buy our shares from us anytime during the life of that contract up to 4 p.m. Eastern Time on expiration Friday. The final word in the term is writing, which simply means that we are initiating or starting a sell to open trade. So that's what it will say on our broker trade form. It will say, you'll go to option, and then it'll say activity, and you'll go sell to open or STO, and then you enter the trade, the option that you want to sell. So covered call writing, we buy the stock, we sell the option, therefore we are initiating a sell to open trade. Here's a preview example that I use in most of my presentations. We're going to be getting into a lot of real life examples coming up. This is just establishing a foundation for those new members of the BCI community, which we issue a warm welcome to all new members, and of course those who of you who put us on the financial map. You know, Barry and I and my team, we're just a few people with some ideas. You're the ones that made BCI formidable in the financial community. This preview example, we're going to purchase 100 shares of company XYZ at 48 a share. That is our cost basis, our investment, $4,800. Now we are covered, folks. So we then sell the option. We sell some unknown person the right but not the obligation to buy our shares from us, and we're going to use the out of the money, higher than current market value, $50 strike in this hypothetical. Okay, so we sold the option. Now we have undertaking an obligation, and we want to get paid for that. So we do get paid for that. In this hypothetical, $1.50 a share or $150 for the 100 shares. As most of you know, trading commissions are negligible. We no longer have to pay a base premium that we used to pay plus a per contract commission. It's just a per contract commission, which usually ranges anywhere from 50 to 75 cents a contract. It's negligible. So we don't put this into our calculations. Anyway, an initial time value return of $150 on a cost basis of $4,800 represents a 3.1% 1 month return, and that annualizes out to 37%. Now, folks, this doesn't mean we're going to end up with that return for that contract month. That's our initial structuring. That's our starting point. Now, it could end up more, and it could end up less, but that is our starting point. Now, one other thing about that premium. $1.50. I use that as an average premium for the kind of stocks I use in my portfolios, which are basically growth companies, the kind of stocks that you see in our membership stock list when we send it out over the weekends. Those are the stocks that I use. I use ETFs in my mom's portfolio. But if we were using a security that had a higher implied volatility than this hypothetical stock, the premium would be greater. If we were using a security that had a lower implied volatility than this hypothetical one, the premium would be less. So the option premium we receive is directly related to how volatile the underlying security is. And it is so very important to identify what our personal risk tolerance is before we know what option and what security to use in our portfolio. Now, for me, I shoot for 2 to 4% a month for my initial time value return, whether I'm doing an out of the money strike or an in the money strike. I shoot for 1 to 2% in my mom's more conservative portfolio. What's right for you? Only you can determine that, but I'm happy to share with you what I do. Now, there are two major outcomes to this particular hypothetical trade. Let's assume for a moment the price of XYZ remains under 50. Think about this now. Is the option buyer going to exercise that option and buy our shares from us at 50 if the price of the stock remains under 50? The answer, of course, is no. So the option expires worthless. We keep the $150, and we will then have realized a 3.1% 1-month return on the option side. We still own the shares, and now we're free to sell another option the following contract month. Okay, now let's look at the second possible hypothetical. At the end of the month, the price of the stock does in fact move higher than the $50 agreed upon sales price. Well, if we take no action and don't buy back the option, which we are free to do at any time up to expiration, let's assume we do not, and the price of the stock is 1 penny or higher than that $50 agreed upon sales price, well, our shares will be sold the next day on Saturday. So we go into our broker account and we take a look and we go, boy, where did my stock go? And then you go, where did all that cash come from? Well, the shares were sold at the strike price. So in this particular hypothetical, what we're doing here is we generated 150 on the sale of the option, 200 more on the sale of the stock. That's a total of 350 on a cost basis of $4,800, and that represents a 7.3% 1-month return. Now that annualizes out to that ridiculous number you see at the bottom of the screenshot over there, 87%. So let me stop and state the obvious, ladies and gentlemen. You're not going to get that kind of return on every position in your portfolio every month of the year. You knew that already. However, I've been doing this for more than 20 years now, and I could tell you that you will see a few of these every month. So you have to know how and when to use this type of strike, the out of the money strike, as well as how and when to use the in the money strike. We're going to be showing you real life examples of that. So why should you sell covered calls? It certainly shouldn't be because I said so, or as I oftentimes in my seminars say, some screaming guy on TV told you to, or some newsletter told you to. It should be because you've educated yourself, you've done your due diligence, and you've made an informed, non-emotional decision that this is the right strategy for you and your family. Here are the reasons why I use covered call writing and have been for more than 2 decades. This is a strategy that can be crafted to meet almost any market condition. Forget about what you used to hear, that it's only for neutral markets. That's not the case at all. You can craft this strategy for bear markets, volatile markets, bull markets, just as long as you've mastered the 3 required skills. I promise you, you can beat the market in just about any market environment. It's a strategy you can teach to your children or help your parents, as I do in my mom's case. One of the things I love about it is that you can use position management or exit strategies you're in two positions, to manage those positions to both mitigate losses when trades turn against us or enhance gains. We even have an exit strategy where you can get more than a maximum return. Those of you part of the BCI community for a while know about the mid-contract unwind exit strategy. Now, exit strategies is beyond the scope of this presentation, but it's a big part of all of my books and online video classes and so on and so forth. All of you know how much I stress exit strategies as it relates to option selling. Now, another benefit of this strategy is that we have downside protection. Now, look, we are lowering our cost basis, folks, and that is the reason. This is not rocket science, by the way. Why should covered call writing beat the market on a consistent basis? We're lowering our cost basis. In the preview example, we bought a stock at 48, sold a 50 call for $1.50. Well, our break even is 46.50. Your next door neighbor who bought that same stock and didn't sell an option has a break even at 48. That is the reason why we should beat the market consistently once we've got mastered those three required skills. Now, one other minor perk, I'm not using this strategy because of this, but as a share owner, we, the share owners, capture all corporate dividends, not the option holders. So as long as we own the shares by the ex-dividend date, on the ex-dividend date, we capture the corporate dividends. Consider that more icing on the cake as a real major perk to covered call writing. And finally, the last highlighted bullet is that our government and every broker that I know of allows us to use covered call writing in our self-directed IRA accounts. And the reasons are simple. It's considered very low risk. It's not no risk, but it's very low risk. And it's also very intuitive for retail investors like ourselves. And that's the reason why it's the lowest level of option trading approval. Now, every strategy, and I mean every, where we're seeking to generate higher than a risk-free return, AKA treasuries, let's say, has disadvantages, and covered call writing is no exception. The second bullet is the main disadvantage, but I put 4 up here, so let's go through them. If the stock price declines below the break even, we could start losing money. That's where our position management skill set kicks in. But because we are stock owners, that's where the risk comes in, not in selling the option. Now, the main risk to covered call writing, folks, focusing on this one, because you have to accept this if you're going to use this strategy, is that our profit potential on the share side is limited by the strike price. So in that preview example, if that $48 stock blew past the 50 strike and went to 55, let's say, and we want to get our hands on those additional 5 points, we cannot because of our contract obligation. But as I say here, don't get greedy. If you generated a 7% 1 month return, is that a reason to break out the Kleenex? I say no. But that is the main disadvantage to covered call writing. So when you're making a decision, a family decision, whether or not this is the right strategy for your family, you must be willing to accept that in some situations, you would have made more money just owning the shares without writing the call. But the lion's share of your trades will beat the market because you're lowering your cost basis. Now, the last 2 are minor disadvantages. Number 1 is early assignment risk. For those of us trading in non-sheltered accounts where we have stocks at a low cost basis, we don't want our shares sold because of maybe capital gains issues. So I teach how to avoid early exercise 99% of the time. Nothing's 100%. But in my material, I teach how to have a successful covered call trade without assignment almost all the time, if that's the situation you're trading in. Now, I prefer trading in sheltered accounts whenever possible, and most of my option selling portfolios are, in fact, in sheltered accounts. So I could care less about taxes. As a matter of fact, have my shares early, please. That just gets me my money back early, and then I just get that money working right away. So it depends on the particular situation that you're trading in. And finally, there's a learning curve and time commitment. But the learning curve for most retail investors, and I know this because we have been so fortunate to have thousands and thousands of covered call writers from all over the world, not just here in the United States, but over 80 countries throughout the world that follow the blue collar investor. And the average retail investor starting out with little or no knowledge will need about 3 or 4 months to get up to speed where it makes sense to risk your hard-earned money. That means mastering the 3 required skills and also paper trading a little bit. So give yourself time if you're just starting out. Don't rush it. You know, master the 3 required skills, paper trade a little bit, start off small, and then after that, build up, and then you have years and decades to benefit from this strategy. So here are the 3 required skills I've been alluding to. What stock or exchange traded fund are we going to select? We have a screening process. We're going to go through that with you this evening. And by the way, it should not be based on getting the largest option premium. That's like one of the biggest mistakes that covered call writers make. They go for the gusto. That's a big mistake. Remember, we're using a low risk, conservative option selling strategy. We shouldn't become cowboys when it comes to selecting the best, the highest yielding stock or ETF as it relates to selling call options. Option selection, we have decisions to make regarding the expiration date. Now, I told you my preference are monthly options, 4 to 5 weeks. But we have many members of the blue collar investor community that use weekly options. Nothing wrong with that. You can make a lot of money, beat the market consistently with either one. I discourage long-term options for a multiplicity of reasons. Now, once we enter the trade, then we immediately go into position management mode. And I'll show you later on in the presentation the first step in position management, which is entering the 20% guideline. I'll show you that in a real life. I'm pretty sure I have an actual screenshot from my broker account of how you do that. All right, here are 4 approaches to stock selection. There are more, but those of you who are members of the Blue Collar Investor Premium Service, you know that we have reports to meet everybody's needs. Now, traditional covered call writing, folks, is what I use. We do a fundamental analysis, sales and earnings growth. And the reason that's so important to me and to us, because we're all part of the same extended family here, I root for you just as hard as I root for myself and my family, is that the institutional investors love fundamentally sound securities. So I'm referencing now mutual funds, hedge funds, banks, insurance companies, the big boys, the guys that move the market, not retail investors like ourselves. So we start with us fundamentally screening our stocks. Now we have a list of securities that are fundamentally elite performers. Then we look at a price chart. We do a technical analysis. We look for trend and momentum. So these great companies that are performing so well fundamentally, how are they doing from a price perspective today, right now, when we're ready to enter our trades? So we want bullish or mixed chart technicals. We will not accept a bearish chart technical for selling options, be it covered call writing or selling cash secured puts. And then there are a few principles that don't fall into fundamental or technical categories, like minimum trading volume, avoiding earnings reports, diversification, cash allocation, things like that. You'll see that coming up also as part of tonight's webinar. Now, you can also go through screening for exchange traded funds for covered call writing. We'll show you that. You can just look at blue chip companies like those in the Dow 30. And we're going to show you that. And actually, we're going to lean on that particular report and screen for tonight's webinar. And finally, and this probably applies to a lot of you folks, is portfolio overriding. Those of you who have existing portfolios, long-term portfolios of buy and hold securities, probably at a low cost basis. You may not be trading them in sheltered accounts. You want to know if you can increase your return on that portfolio. Maybe you're getting 6 to 10% a year. Can I get another 6% by writing covered calls? The answer is yes. And we teach that as part of our portfolio overriding courses. Now, for traditional covered call writing, we use various pools of stock. You know, those of you who receive our stock reports on the weekends, how do we do that? Well, we look at the IBD 50. We lean a lot on IBD. I love numbers, and that's a very statistical-based proprietary screening service. Those of you who are members, you don't have to join IBD because we do that screening for you along with a lot of other screens. So it's almost like a starting point. But we also have a database of securities that we've identified over the years, a couple of thousand, that we screen every week in addition to the IBD 50, the IBD Can Slim, and the IBD Big Cap 20. So we screen those IBD screens plus our database of thousands of stocks every single week. We probably touch, I think Barry told me, 3,000 to 5,000 data points to prepare our reports for our members on the weekends. And that's why we start after the market closes on Friday, and the report takes us about 15 hours to formulate. And I have to tell you, Barry does the lion's share of that, does an amazing job on that report, which is geared not specifically to buying stocks per se, although you can use it for that. It's geared specifically to short-term option selling. It's a very unique report. Now, we also have additional fundamental and institutional analysis that we use. The IBD Smart Select screen basically evaluates both the stock and the industry the stock is in from a fundamental and technical perspective. So we only accept the elite rankings for each of those categories. We also use mean analyst ratings, or MAR. And so we have analysts that follow each security, and they rank the securities 1 to 5. 1 is the best, 5 is the worst. We only accept stocks that have MARs of 3 or under. And finally, on-balance volume. What on-balance volume is the volume on an up day, the stock went up, is put in as a positive, and then from that, subtracted volume on down days, and you get a line. It's the trend of that line that's important, not the actual number. And in our reports, you'll see arrows going up, down, or sideways. So that'll give you an idea of where the institutional money is going with that particular security. Now, I'm going to just briefly go over the technical analysis because we have a lot to cover here tonight. So I'm just going to show you the 4 parameters that I use. Feel free to use whichever ones you're comfortable with, but for trend, I use the exponential moving averages. The top line is the 20-day EMA. The bottom line is the 100-day EMA. The reason for exponential, it weighs the more recent prices more heavily, so these lines will move quicker using EMAs as compared to the more standard SMA, simple moving averages, which is what most chartists use when selecting stocks. So what we're looking for is an uptrend. We're looking for the blue line to be higher than the red line, and the price bars or candlesticks to be at or above the 20-day exponential moving average. This is a very bullish signal in this particular chart here for JD.com. Now, the MACD histogram is a trend and momentum identifying parameter. All you have to do is look at these blue bars. Are they above the 0 line? Yes, they are. That's a bullish signal. Then we're going to look at the stochastic oscillator, which is also a momentum indicator. We like to see it moving up. Now, when it's above the 80th percentile, as it is here, it's considered overbought. That doesn't scare me. I've seen securities in overbought for months at a time. What you worry about with this particular overbought is if it dips below the 80th percentile, that's a slightly bearish signal. And if it comes back up and dips below a second time, that's a very bearish signal. So we keep an eye and let you know in our reports how the signals are going. And then finally, we confirm everything with volume. These parameters on the top are more significant on high volume and less significant on low volume, let's say on a holiday weekend or something like that, when the market makers are away. So that's how you read a price chart. Once you familiarize yourself with these price charts and use the same parameters for every stock you're evaluating, then you could read a price chart in like 3 seconds. Now, of course, the good news is for those of you who are members and get our reports, you don't even have to bother with that. We do that for you. Now, let's look at some of the common sense principles. I told you never, ever write a covered call or sell a cash secured put if there's an earnings report coming out prior to expiration Friday. That's the most important of these common sense principles. We also have a list of banned stocks that you should never use for covered call writing or selling puts. And premium members, that's on your on the site, the member site, but it's also free on the free resources link, which I'll show you later on for those of you who are not premium members. And these are stocks that report same store retail sales on a monthly basis, and also the airline stocks that report capacity reports every month. So we don't like to use those because they act like earnings reports. So that file is available to everybody. We want a minimum daily trading volume of 250,000 shares per day. We want some liquidity, just like we do with the options. And we want stock and industry diversification as well as cash allocations. The very specifics are in my books and DVD programs. Many of you already know this. Now, here's the top of one of our reports, our stock reports, all across here. I'm not going to go into all of these, but basically they're the three-pronged screening approach I just alluded to: fundamental, technical, and common sense principles. That's how we do it, and that's how we form these particular lists. Now, anything in a white cell is eligible, and if it's in a gold cell, it'll be eligible after the earnings report passes, and we have earnings report dates for you as well over here. So you could kind of use this list however you're comfortable using it. A very common way, a lot of our members like to use it, they look for stocks in bold, like on the left you see team, that meant the strongest chart technicals, and then they go over to the rank of the industry, which, let me just get my arrow back over here. Here. So they look for bold stocks with industry ranks of A or B, and so that's how they start. But you could really craft this to your needs in many, many ways, because there's so many different data points that we go through to provide to our members. Now, what if you're not a member and you don't want to become a member? That's fine too. We'd love to have you here in our BCI community as a general member. There are a lot of free screening services. Unfortunately, most of them are geared just to stock selection, not to covered call writing or short-term option selling. But a good free site is finviz.com. And then you could use the drop downs, like you see these arrows here, and you could use the drop downs to put in the parameters that you feel are the most important ones. As you see here, earnings per share growth positive. Technically, it doesn't have a lot, but it does have simple moving averages, 250-day simple moving averages. You could look at certain fundamentals like the PE to growth or PEG ratio. So that's a good free site to get a screening for your option selling stocks if you don't want to become a premium member. But once again, there are a lot of services out there, mostly paid, that will provide lists of stocks. Now, what about for exchange traded funds? That was for traditional covered call writing the way I do it. We look for top performers over the last 1 and 3 month time frames. So in our reports, we look for ETFs that outperform. I'll show you a screenshot in a little bit, that outperform the S&P in both of those time frames. So it's showing very current strength and a little longer term, 3 months strength. Now, all of our ETFs have relative strength ratings of 60 or better over the last 3 months, which just goes to show you how it relates to all the other securities in the stock universe. I do not like to use leveraged ETFs. I get this question all the time. And those are more highly volatile securities that give greater premiums, but also there's greater risk to the downside. So I look at it like you're taking a low risk strategy and you're converting it into a high risk strategy. I don't see the point to that. The only exception, and I talk about this a few times a year, or in unusual rare situations when the market is crashing like it did in March this year, where I'll turn to inverse ETFs. Those are ETFs that go up when the market goes down. And I'll always publish in our reports to our members when I use inverse ETFs. It's very rare, but we do put it in our reports anyway. And finally, the ETFs have to have a minimum average trading volume of 250,000 shares per day, and the options associated with them should have a liquidity of 100 contracts of open interest and or a bid-ask spread of 30 cents or less. That's all in my material as well. So here's what our ETF report looks like, and you'll just let me quickly show you this here. The S&P 500 in the last month when I made this screenshot was up 4.77%. In the last 3 months, it was up 17.78%. You'll notice all the securities that made our report beat the S&P in both of those time frames. Okay, now over here we list the select sector spiders, the top performing ones. It's no longer 3. If there are more, we put them in there. And the select sector spiders divide the S&P 500 into 11 different categories. So for example, let's say we did take the top 3 performing select sector spiders. That means in essence, we now own the top 27% performing stocks in the S&P 500, not the index as a whole. And then we could reevaluate our bullish assumptions every week, every month rather. Now down here at the bottom of this report, those are the inverse ETFs, which we will rarely use. But I'll tell you, when the market crashes, they sure do come in handy. Now, here we go. We're going to be using the blue chip report for the remainder of tonight's presentation. And these are securities that outperform the S&P 500 from the Dow 30 in also the 1 and 3 month time frames. And we're going to assume a quality assumption since they are in the Dow 30. So we don't have to worry about fundamentals and things like that. We start with the Dow 30, and then we look for the best performing one in those 2 time frames. We were going to diversify our portfolio because that's smart. We're going to allocate a similar amount of cash to each position because that's smart. We don't want any one position, if it turns against us, to impact our portfolios in a big way. So that's what we're going to use in tonight's presentation. Now, there are 2 critical dates to watch. I told you also before about earnings reports, to never be in an option position if there's an earnings report prior to contract expiration. A very excellent free site is earningswhispers.com. That's what we use for our reports. Now, for those using stocks that they don't want sold, you have to avoid ex-dividend dates. We teach that. But first you have to know when the ex-dividend date is, and a very reliable free site is dividendinvestor.com. That's what we use in our reports. Now, we can use, and I frequently do, weekly options to circumvent earnings report and ex-dividend dates. So let's say, folks, for example, that there's an earnings report or an ex date in the 3rd week of a 4-week contract. Now, if we wait for the event to pass before we sell an option, we will have lost out on most of the time value premium for that month. So what we could do is start off by selling a 2-week option if that security does in fact have weeklies, which the Dow 30, most of them do, or maybe all of them do. And skip the 3rd week and come back and sell a weekly the 4th week, and then the next month go back to monthlies. There's an answer to everything. Okay, so folks, here is the example of the blue chip report we do monthly for our members. So the stock reports are weeklies, the ETF report are weeklies, the Dow 30 or blue chip report are monthlies. As a matter of fact, I just posted the new one for the November contract today. So for those of you who are premium members and didn't see that, it's up there now. Okay, so you see here that we do a 1-month and 3-month price performance, and all the securities have beaten the market, beaten the S&P 500 in both of those time frames, as you see here. Now, I highlighted in brown Procter & Gamble, Dow, and Home Depot, because when we sort these, we sort them by 1-month price, the most recent 1-month price performance best to work. Now, even those 3 that are the lowest 3 performing of the 7 securities that are here now, they still beat the S&P 500 in both time frames. So I'm not saying they're weak, but I'm saying of the 7, those are the weakest. So those are the ones I'm going to use for in-the-money strikes, a more defensive position because they have an intrinsic value component. Therefore, we have greater protection to the downside. So that's how I'm going to formulate our portfolios. We're going to be using in-the-money strikes for PG, Dow, and HD. Okay. Now, here's just a summary of the stocks that we're going to be using in this portfolio that I'm setting up tonight. Apple, we're going to use out of the money. Salesforce, CRM just added to the Dow 30, out of the money. You see the 3 that we're going to use in the money strikes where when we're calculating our initial time value profit, we must deduct the intrinsic value. Not to worry, the calculator does that for us. And the others, Honeywell, Nike, are also out of the money. So that's how we're going to structure. Now, I'm going to set up an initial hypothetical portfolio of $250,000. Now, many of you, that's way more than you have available. Many of you, that's way less than you have available. We have a wide range of folks here tonight, and you're all very important, but I just want you to know that you could craft this strategy to your particular needs. So this is the hypothetical I'm setting up now. So we have 7 elite performers from the Dow 30. So if we had 250,000 available cash, that means we're going to allocate approximately 36,000 per position. So we divide the price per share into 36,000 and we round off to the nearest 100. Remember, when one option contract consists of 100 shares of the underlying security. So if we own, let's say for Nike, if we owned 196 shares of Nike, you can only sell 1 contract, have to buy 4 more shares. So that's why we round off to the nearest 100. Now, life is not perfect, folks. I don't know if you know that, but it is not. And therefore, the first go round, we may have to adjust our portfolio. I'm going to show you exactly that coming up. And you have to leave a reserve of cash because position management is critical to our success. So if we have to buy back an option, we need cash to do that. So we can't use up all of the available cash to buy shares. We have to have some set aside. Okay, about 2 to 4%, which in this case is 5,000 to 10,000. Now, what is our goal? Well, we're using blue chip stocks. My goal is 2 to 4% with growth stocks. We have to drop that a little bit. Blue chip stocks from the Dow 30 are not going to generate the option premium yield that we get from growth companies because they're not as volatile. Simple as that. So our goal is going to be somewhere between 1 and 3%. Whether it's in the money or out of the money, that's the time value we're going to shoot for. Now, after we place our trades, we're going to enter that 20% buy to close limit order, protecting us if the price of the stock drops. We can buy back that option and be prepared to take action. So I'll show you a screenshot of the very first step in position management, which again is not within the scope of tonight's presentation. I think you could see that I'm providing a lot of information here, and the exit strategies is like a whole webinar unto itself. Maybe we'll do that at a future BCI webinar. I'm waiting to hear back from you as to what you'd like to hear from me. That's how we base this particular presentation tonight. Okay, so here's how we did our initial portfolio setup spreadsheet. Now, we told you how many shares rounded off what we just did, and that shows you here. So, okay, let's say we did that, and we bought the shares based on the first go-around. Well, take a look at how much that would cost us, $265,724. We only have $250. Plus, we need extra money for exit strategies. No good. How could we get with $15,700 over, right? Plus, we need about $5,000 for exit strategies. We need about $20,000. Where are we going to get that from? Well, on first look, the first thing that stands out is if we bought only 100 shares of Salesforce, that'll free up $21,680. So we're going to change to 100 shares of Salesforce, and that will solve our problem. So let's see what the spreadsheet looks like then. Okay, now we're cooking, folks. Okay, so you can see here, we changed Salesforce to one contract, and that means we spent $244,000, leaving us almost $6,000 for exit strategy execution. That's what I call perfect. So you have to adjust. You know, it may come out the first time, but if it doesn't, you have to say, okay, how much am I over, and where am I going to get it from? And just look at the spreadsheet, and usually you'll figure it out. Okay, what options are we going to select? Well, I told you in this particular case, I'm going to favor 1 month options. Weeklies are going to be used to circumvent ex-dividend dates and earnings dates, specifically earnings dates, ex-dates if you know, you're in a non-sheltered account. And we're going to use out-of-the-money strikes here because we're going to allow share appreciation. Okay, in this particular, our goal is to allow for share appreciation. We're going to assume a neutral to bull market environment. If it was a bear market environment, I would favor in-the-money strikes. And we're going to use a few of those to show you how they work. And those in-the-money strikes are going to be used for defensive positions. If you recall, I selected the 3 of the worst performing of the elite performing Dow 30 stocks. So out of the money to allow for share appreciation, a bullish stance, in the money for defensive positions, a defensive stance. Okay. Now, initial time value return goal range, 1 to 3%. Now, if we were using portfolio overriding, I'm throwing this out now, even though it's not related to the rest of the webinar, because I know this applies to so many of our members that have portfolios of buy and hold, low cost basis securities. They're just looking to generate additional income. So you really need to get the information I provide on portfolio overriding, where our monthly goal is going to be 0.5%. So you could use strikes way, way higher than the current market value. Now I'm going to show you 2 options chains. One for the in-the-money strike, which we're going to be using for Home Depot. Remember, this is one of the 3 stocks at the bottom of that sorting list. And at the time, Home Depot was trading at $285. So we're going to use the in-the-money, lower than current market value, $282.50. And that generated a bid price of $8.40, $840 for the contract, per one contract. Now, you know, we sell at the bid and buy at the ask. Sometimes we can negotiate a better price, but for right now, we're going to use only the bid prices. Now we're going to show you the out of the money. We're going to show you an example from out of the money for Salesforce CRM, which is trading at 216. So for calls out of the money is higher. We're going to look at the 220 strike, which had a bid price of $7.55. Probably could negotiate a better price than that because you see the spread is 75 cents. So but we're going to use worst case scenario, the published bid price. So this way you could see and then say, oh, it could only have been better than that. Now, if we did want to negotiate, let me take a minute to show you how to do that. If we did want to negotiate with the market maker, and I like to use this if the bid-ask spread is 15 cents or greater, what we could do is we can put in a limit order between the bid and the ask and favor the market maker slightly. So in the case of Salesforce, you remember the spread was $7.55 to $8.30, a 75-cent spread. So the first thing you do is find the midpoint, which is called the mark of the spread. In this case, it's 7.925. So I would place a sell to open limit order somewhere around 780 to 785. And now the market maker must decide, should I give Alan his 785 or should I publish that limit order, thereby decreasing the spread? Most of the time we'll get it. As long as you favor the market maker a little bit. Now some brokers will do this, some of this for you, but if you want to have control, place the limit order at a price lower than the mark, and frequently you'll get it. Worst case scenario, you'll get the published bid. Now, if you're going to use this strategy, if your broker form has an all or none box or AON box, do not check that box, because if you do, the broker will not be subject to this all show or fill rule. Now it's time to introduce our newest spreadsheet, the Elite Plus Calculator. The top part of the spreadsheet is for covered call writing. The bottom part is for put selling. You have the individual positions here. You have your portfolio position here. We also have exit strategies for covered calls down here. We'll show you all that as we move forward. Now, all the information that I just showed you for these 7 securities are put into the blue cells. So the option month was September 2020. The expiration is 9/18. These are 24-day trades, folks. That number will come up automatically when you just put in the other information. So 24-day trades, almost a month. Here are the 7 securities. And in our stock reports, we give you the industry. You can also get that from finviz.com, but it's in our stock reports. The earning report dates are in our reports. The ex-dividend dates are in our reports. The stock price you got from the option chain, or our reports give you the price of the stock or security at the time we made the trade, but by the next day, the price is different. So you have to look that up, but that'll be in the option chain. Here's the option prices you got from the option chain. Strike prices we talked about, number of shares. We went through that with cash allocation, and they expired on 9/25. Okay, so the expiration date I have up here is a week early. It's 9/25 according to this spreadsheet here, but it's a 24-day trade. Okay, so now once those blue cells are filled in, we then get the information in the white cells on the right side of the spreadsheet. I'll go through those as well as the yellow cells so you can see what they're all about. And by the way, when you have the spreadsheet, if you're not sure how we got a particular formula, if you hover over the title of each column, there's a user guide within that. It'll come up. So just put your cursor over that, like the cross, and the user guide will come up and explain the formula that we used or the definition of what we're talking about. Now, the time value premium is based on what you got from the option chain, right? So in the case of, let's use Salesforce here, it was $7.55. Remember, we went to the bid price, $7.55. Now, the case of Home Depot, it was $5.90. Okay, so that's the time value. Now, where did we get $5.90 from? Wasn't it $8.40? Yes, but we have to deduct the intrinsic value, which was $2.50. Okay, so when we sell it in the money strike, you have to deduct the intrinsic value. The spreadsheet will do that for you. You don't have to worry about it. All right, so that's where we get these numbers. Those are the option premiums. And intrinsic value applies only to the 3 securities where we sold in the money strikes. Now, upside potential is the amount of additional dollars we can make per share when we sell an out of the money strike. So for Salesforce, as an example, it's $3.20. Where did we get that from? Well, we bought Salesforce at $216.80 and sold at $220 strike. So there's an opportunity for an additional $320 per contract, right? And so you'll notice that for Home Depot down here, there is no upside potential, okay? Because it's an in-the-money strike. But we did have that intrinsic value, which will represent some downside protection. Okay, now let's go to the break-even column over here. Break-even is simply the total price of the stock minus the total option premium, whether it's in the money or out of the money. So that's our break-even. We're lowering our cost basis. And again, that's the reason why we're going to beat the market on a consistent basis, because we're lowering our cost basis. Now, the return on our option is the time value option premium divided by the stock price or the strike price, right? If we sold an in-the-money call, it would be the time value premium divided by the strike price. If out of the money call, it would be the time value divided by the stock price. So those of you that need to research that a little bit more, it's in my material. It's in the user guide in this spreadsheet as well. Upside potential for out of the money strikes is the amount of additional percentage return you can get if the price of the stock moves from current market value up to the strike price. So for Salesforce, you get a 3.50% initial time value return, and there's a possibility of an additional 1.50% if it moves up to the strike. That means you have a total possibility for that 24-day period of 5% return. Doesn't mean you're going to get it, but that's how the trade was structured. Now, downside protection only applies to the in-the-money strikes. So, for example, over here, the case of Home Depot, it's a pretty small downside protection, not even 1%, but a downside protection nonetheless. So if Home Depot stays above the 282.50 strike, that means we will have realized our 24-day 2.1% 24-day return. Now the REVB premium, that's the actual time value premium in dollar amounts. The other column was for percentile amounts. That's the dollar amount that you get by selling. So for example, for Salesforce, it was $755 for the one contract. Now, Home Depot, it was $590 for the, how many contracts of Home Depot? That was also 100. But for those that had multiple contracts, like for example, Nike, you would take your profit and multiply it by 300. So it was the total upside potential of $420 in addition to the original premium that you generate, original time value premium. So that's the upside premium, and then the total invested is the price of the stock times the number of shares. In the case of in-the-money strikes, it's the number of shares times the strike price, because we use the intrinsic value component of the premium to lower our cost basis down to the strike price. That's all those formulas are in my material and in the user guide as well. So I'll explain to those of you who are new to it. So now we have our individual positions. Let me just clear all that. We have our individual positions, and now we want to take a look and say, hey, how are we doing as a portfolio as a whole? Well, the total number of contracts is 19. This just comes up automatically once you fill in the blue cells on the left side of the spreadsheet. So if you count up all of these shares per contract, it comes to 19. 1,900 shares, 19 contracts. Now the total portfolio return on our option, that's time value only, these columns here adds up to $62.59, $6,259. That's our initial time value premium. Now, what about on the upside, if on the out of the money strikes, and they weren't all out of the money, only 4 of them were, but if those shares did move up to the strike price, that would generate an additional $4,450. So our total structuring potential return for that 24-day period is $10,709. Now, our total cost basis invested, remember now the intrinsic value is deducted when we sell an in-the-money strike, comes to $242,400. That means our initial time value return without upside is 2.58%. With upside would be 4.42% for that 24-day period. Now, in addition to that, we do have 2 more tabs to talk about in just a minute for covered call writing exit strategies down over here. Let me just clear this slide first and move on to show you, before we get into the exit strategies, how to set up your trade using a broker execution trade form, and then I'll show you how to put in that 20% buy to close. So when we buy a stock like Nike, you just put in an action that you buy, and how many shares, in this case it was 500. I usually do market orders for stocks like these because the bid and ask spread is very, very small here, as you could see, 109.55, 109.75. You put in a market order, day only, and it will give you an estimated amount, and then you execute the trade. Now, once we do that, we are now covered. We're protected. So that's the first word in covered call writing. Now we're free to sell the option. So in this particular case, we're going to sell the 105 call option. What action do we want to take? Sell to open. Might say STO, but sell to open. How many? 5 contracts. Day only. We're going to put a limit order now of $575. The bid was $575. The ask was $6. I normally would put in probably $585. $580 at the worst, and I'd probably get it. But again, I'm showing you worst case scenario here. And the estimated amount you see on the right middle is $2,875 for the 5 contracts. Now, once we enter the trade that way, that is known as legging in. So buy the stock first and then sell the option. Many brokerage trading platforms have what's known as a buy-right combination form. What did I do there? Okay, so you could see buy-right combination form. Now, a buy-right combination form was you enter the stock leg and the option leg simultaneously. And your action is to buy the stock and sell to open on the option, the number of shares and the number of contracts. So it's all in one form. But now you have to put in a net debit limit order. So the price of the stock, of course, is much greater than the option premium we're looking to generate. So in this particular case, the stock price was $109.75 and the option premium was $575. So we'd enter a net debit limit order of 104, which means we're telling our broker to only execute the trade if we have to spend $104 per share or less. Okay, and it'll tell you the estimated amount is $52,000 in this particular case. So that's if your broker has a buy-right combination form, that's how you would do it with that form. I prefer legging in. It gives me a little more leverage with the show or fill rule, but this is fine, too. It'll make things a little quicker. You can also enter your trades when you're not in front of your computer by using this form. So when you're entering your buy to close limit orders using the 20%, 10% guidelines, if you're using monthlies the way I do it, you start out with the 20% guideline, which means you're going to close your short option call if the price of the option moves down to 20% of the price that you sold it for. So that means the price of the stock is declining. So for example, we sold the Apple call at $15 a share. 20% of that would be $3. Midway through the contract, we changed it to 10% or $1.50. And so on. Salesforce $1.50, which is 20%. Halfway through the contract, we change it to 75 cents. Kind of round them off. It's never going to come to exactly within 5-cent increments. So you kind of round it off. And you change that before the last 2 weeks of the contract. Now, if that happens and it's executed, you're going to tell your broker that you want email or text notification when that is executed, if it's executed. Then you simply own the stock and you can plan for what your next step is going to be. But almost every broker will offer this notification. I get them all the time. Now, once we enter the trade, this is how you do your buy to close limit order. So you put in the option that you sold. It'll ask you what your action is. Before it was sell to open, now it's buy to close. How many contracts? 5. We want to do a limit order. Here it is, $1.15. That's 20%. Good until canceled, not day only. Good until canceled. And it might say GTC. How much are we going to spend to close? $575 for the 5 contracts. That doesn't mean it's going to be executed. Maybe, maybe not. But if it is executed, that means our shares are going down in price and we need to monitor the trade. And this is how we do it. If that's executed, we're not in front of our computer, we get that text or email from our broker. Now we know we got to check it out. What are we going to do? Wait to resell the option, roll down to a lower strike price, sell the stock? All that information is part of the BCI methodology in a very big way. You all know that. Now let's take a look as we're kind of closing in on the end of the presentation now. On the exit strategy tabs on the calculator, what now and unwind now tabs. The what now tab is for rolling options. If the strike is in the money, I'm just going to do these briefly because I can't do justice to position management in the few minutes that I have left. But when you're using the What Now tab, your strike is in the money as expiration is approaching, and you may want to hold on to the shares. So put in the information on the cost to close and the cost to open a new option the following month. Excuse me. So if you roll out to the same strike, it'll tell you things like, well, if you roll out, you're going to get a 1.5% 1 month return with a downside protection of 6.40%. So it's telling you in this particular example, which is unrelated to the spreadsheet I just showed you, just shows you how to use this rolling tab, the What Now tab. If you're okay with a 1.50% 1 month return, as long as share value does not decline by 6.40%, you may roll out. Or it'll tell you what happens if you roll out and up, which means you're going to get a 2.70% 1 month return. And if you rolled out and up to an out of the money strike, you might even get a 4.25%. So it will give you what your rolling statistics are going to be for initial trade structuring. And then you could say, you know what, that's for me or that's not for me. Now in the Elite calculator or the Elite Plus, this one calculator, we also have an Unwind Now tab that's not in the basic Ellman calculator. And that tells us the following. Let's say share price goes to the moon. Now, as the price of the stock goes up, it leaves the strike deep, deep in the money. And a typical characteristic of a deep, deep in the money call option is that the time value cost to close approaches 0. Now, the intrinsic value could be humongous, but we get that back because the share value moves up from the strike price to current market value. So it's almost a wash there with the intrinsic value. But this will tell us the time value cost to close. In this case, 0.17%. You know, just a small fraction of 1%. So depending on where we are in the contract, we ask ourselves, you know, if I close my position in its entirety, short call and sell the stock, get the cash from the sale of the stock, can I make at least 1% more, 1.17% or more with a different security in the same contract month? If the answer is yes, you may want to go ahead and unwind and generate a second income stream with the same cash investment. So those are the two position management tabs that are part of this calculator. Ladies and gentlemen, let me just give you a summary. Then we'll go over a few of our products with the discount coupons, free resources, and I'll check in with Barry on the Q&A. Stock selection involves fundamental, technical, and common sense analysis for traditional covered call writing. Option selection is based on the time frame. I like monthlies. Weeklies work fine as well. We have to decide on the moneyness of the strike. In the money, more defensive. Out of the money, more bullish. We have to know what our initial time value return goal range is. That has to be established before we enter a trade. We use 1 to 3% in this particular presentation. You have to have a portfolio construction spreadsheet to determine the makeup of our portfolio. You may have to go to a second round of it if it doesn't work out perfectly. And then we must be in preparation for our position management after we enter our trades based on that portfolio construction spreadsheet. Start out with 20% guidelines if you're doing monthlies. In the last 2 weeks or weeklies, you're going to use the 10% guidelines. Now we're going to go through some products to facilitate these trades, and we'll look at the premium stock reports and Elite calculator. Now, covered call writing is a low risk, not a no risk strategy we use to generate monthly cash flow. I've been using it for my family now for more than 2 decades. I've beaten the market every single year, even back in the 90s when I wasn't as good at this then as I am today. I want you to go from point A to point B where I am as quickly as possible. That's why we provide all this information to our BCI community. And you can craft this strategy to accommodate all different kinds of personal trading styles. I did a webinar on Monday showing 4 different ways of using covered call writing. So, you know, traditional isn't the only way you could use this strategy. And many of you have seen my videos and you know exactly what I'm talking about. But whatever form of covered call writing you're using or put selling you're using, You must master those three required skills: stock selection, option selection, and position management. Take your time, folks. Educate yourself. Paper trade or practice if you're just starting out. 3 to 4 months for those of you new to option selling. And then you're good to go for years and decades. These are the two discount coupons we're offering to all of you out there. For those of you that want to purchase items from our store, BCI 10. For new annual subscriptions, BCI 100. That's $100 off our annual subscription. That's good for tonight and tomorrow. If you go into the BCI store, you will see that the top left are online video classes. They used to be called DVDs. Now they're online. You can download the workbooks. We have about a dozen of them, purchased separately or bundled. Feel free to take advantage of the discount coupon for those. On the lower left are the calculators, including the Elite Plus calculator. We have about 10 of those, also individual or bundled. Our books are available in three formats: ebook, softcover, and we have a few available in hardcover as well. Below this, can't see it in the screenshot, we have a trade planner and online mentoring programs. Most of you have my complete encyclopedia for covered call writing, the classic edition. Should be read first before volume 2. Excuse me, folks. That classic edition has been #1 on Amazon since it was published. I'm very humbled about that. This book also has been #1 on Amazon on selling cash secured puts since its publication. Thanks to you folks. Now, the latest book that Barry and I came out with, we co-authored this one, Covered Call Writing Alternative Strategies, details portfolio overwriting, the collar where we add protective puts to our covered call trades, and the poor man's covered call, which is using a leaps option instead of a stock on the long position. I hope and to believe in my mission statement is that that resource and our Poor Man's Covered Call online video program is the greatest resource for this strategy, the most detailed resource for this strategy found anywhere. At least you guys make that final decision, but that was my mission. Now, the book that I'm most proud of is not options at all. It's Stock Investing for Students. It's a financial literacy book geared to students and those not near retirement. It's things like dollar cost averaging, dividend reinvestment, difference between mutual funds and ETFs, and it's been picked up by 4 universities here in the United States to be part of their financial literacy program. Membership, I know many of you are already premium members, and there's too many benefits to go through. I will say the meat and potatoes are the reports that we alluded to earlier, 2 weekly and 1 monthly. There are about 200 educational videos, expanded calculators, files, and such for our premium members. The discount, BCI 100, $100 discount applies to the new annual subscription. So from $569, the first 13 months will be $469. Once again, good tonight and tomorrow. Here are the coupons again: BCI 10 for the 10%, BCI 100 for the $100 discount on membership. Free stuff. I've written probably 400 or more articles over the years. If you have a particular topic in mind, like let's say delta, calculations, you name it. I mean, I think I've covered almost everything. Just put in a Google search tool and the articles I wrote on that topic will come up. Number 2 is a glossary I wrote for covered call writing. You may want to bookmark that. Number 3 is where you get the free basic Ellman calculator. Just click on that, put in your email, and you can download it. There's also a single column put calculator. You know, the premium members have expanded versions of these for free, but the basic versions are available there along with about 10 other files. 4 and 5 are training videos. They all have educational values. My team rotates them. Not sure what's up there now, but they all have educational components to them. All right, number 6 is the store where you could purchase books and DVD programs along with the calculators and everything else I mentioned. And now we have our beginner's corner, which can be found on that line under the numbers or on the upper right corner. You see that gold triangle there. Those are two 8-part video tutorials, one on covered call writing, one on selling cash secured puts. They're free. Just put in your email address and then you can enter, and each video is about 10 to 15 minutes. You can also download the PowerPoint slides for free. It'll give you an overview of these two strategies. The details are in the books and the DVD programs, but it's great to have that overview initially if you're just starting out. Now, I also have a newsletter that I write every week. I know most of you get that, and thank you for taking the time to read it each week. But for those of you who don't, go to the blog link of our webpage, fill in the name and email you see there by the red arrow, and you may be asked to confirm it when you get an email back, and then you will get the newsletter, which has, I believe, a tremendous educational value to it. They have charts and graphs. They usually relate to trades in my portfolio or members that shared with me. So they'll be worth while reading. You'll receive them every Sunday morning, 10 a.m. Eastern Time. So, ladies and gentlemen, that's the end of my presentation tonight. I see it took me about an hour and 20 minutes. So I hope I hope you all found this of value. I'm going to check in with Barry now to see if there's any. I see he's been typing away. Any questions still around? If so, I'll stay a few more minutes. Barry, or could you activate your mic? Maybe he can't. Okay, I'm looking in the chat. Please unmute me. Okay. Darius, could you unmute Barry? See if I could.
Always unmute it.
Oh.
Okay, there are two questions. One, both relating to the codes for the products in the store. The first one is, could you please put up the codes one more time, the discount codes?
Let me go back. Here you go.
And the second is, will those discount codes also apply to the ebooks that are on sale on the website?
Yes. Yep. You can, everything in the store is you get a 10% discount. Everything. But if you're going to do the membership, do BCI 100, because that's way more than 10%.
And then another question came up: is there any discount code for the Kindle versions?
No. See, Kindle is an Amazon product, so they handle all that. The way it works with Kindle is they get our books, and when we give them permission, we set the price of the books, and then they collect all the money and send us a check periodically. So I have no control over Kindle, but we do. I mean, there are tons and tons of people that get our books in Kindle format. I will say this though, I know Kindles are less expensive, and you know, we have a lot of international members as well, so shipping becomes very expensive. I get it, but especially the encyclopedias, you know, we have about 150 color charts and graphs. The sense I have is they're much easier to read with the actual soft or hardcover versions. I mean, I'm not here to spend your money. So, but I think it's a little bit better to get those than the ebook format. But we have tons and tons of people that did get the ebook format, and you know, we don't get complaints. So I guess they must be happy and satisfied. But yeah, it applies to the ebooks as well. Anything else, Barry?
Hold on, some last minute questions are coming in. I'm typing the answers now. I think that is it.
Okay, so for Barry and Darius, I want to thank everybody for spending this evening with us. I want to hear from you. What would you like to hear again when we're home with this COVID-19 crisis? I want to stay in touch with all of you. I can't travel the country like I used to for the last 10 years or so, but this is a good way for us to stay in touch in a way that benefits all of us, because you learn and I learn as well. So I want to hear from you. What topics would you like to hear? I have written over 50 webinars over the years. And so I can kind of, I can even write a new one, craft a new one. I just got a contact today from the NASDAQ Stock Exchange. They want me to do something for them. I'm sure that'll involve me doing some kind of new presentation. So I'm always willing to do new webinars based on what you guys are interested in. So thanks again for spending the evening with us. On behalf of the BCI team, I hope you enjoyed it. I hope you benefit from it. And as always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.